Welcome to Investment Wars. I'm Joe Halpern. This is a show about the stories we tell in markets and investing. We all love a good narrative, but we tend to build them from the data points that confirm what we already think and ignore the parts that don't. In investing, that instinct is expensive. A hot take is not a strategy. Access is not the same as responsibility. On this show, we break down big macro themes, pressure test ideas everyone is talking about, and dig into the deeper forces shaping how markets actually work and how investors should think. Investment Wars is brought to you by Obsidian CIO. Obsidian helps advisors and investors think more clearly, invest more deliberately, and build portfolios with institutional discipline, not just more product. My guest today is Dave Thornton, co-founder and CEO of Vested. Before launching Vested, Dave was a serial entrepreneur, including founding and selling Patient Finder, and earlier worked in quantitative investing and risk modeling at Citi. Today, he's focused on helping startup employees access the value they've created through equity ownership while opening private market opportunities to investors. This is episode 39, Bridging the Liquidity Gap, Creating Opportunity for Employees and Investors. Let's get into it. Thank you for coming on the show, Dave.
Hey, Joe. Thank you for having me on.
Definitely. So you've built multiple businesses over your career. You're a multiple entrepreneur, done it a lot. What keeps pulling you back? The thrill of discovering something new or the challenge of turning an idea into a real company?
Something that's kind of adjacent to both of those things, but not quite either. I think that for anybody that's really paying attention to the world, discovering something new is like a 5 times a day experience. And so, having a good idea is, as long as you're really observing the world, is not that novel for most folks. And I also think that the challenge of turning an idea into a company is like it's the tax you pay as opposed to the thing that gets me all excited. Probably the feeling that gets me the most excited is a little bit after the challenge, where you realize that you've taken this idea that you had and probably 100 other people had too, but have actually breathed some part of it to life. So it's the feeling of accomplishment as opposed to the feeling of like running through the wall that keeps coming back. And like you get that opportunity a lot when you become a startup person. Like every little roadblock that you knock down, if you take a second to stop and smell the roses, is actually it's awesome and impressive, and it's something to be proud of. And that feeling is one of the animating ones.
Interesting. Okay, feeling of accomplishment. Because right, entrepreneurship, it just takes so much, right? There's so much work. So getting to that success. I got you. Okay. So you spend a lot of time around founders, around people who work for emerging companies and emerging companies. What are a few ideas or trends you've encountered recently that make you think, wow, that's genuinely interesting?
Well, I guess from the vantage point of Vested, where we get to see lots and lots and lots of different companies, the thing that we get to pick up on most is the trends as opposed to the idiosyncratic things that one company might be doing. And I guess this is a bit of a long answer, but I've noticed, just like everybody else, that large language models and generative AI, and now it's just been shortened to AI, which has lost all meaning to me, but has become the major theme in the last few years. But I'm not personally all that excited about LLMs for the sake of LLMs. Like I like writing my own emails, and I like the process of thinking. So I'm not that excited about that stuff. But that has kind of called into relief the stuff that I see that I am kind of excited about. I'm really, really excited about the use of AI within medicine. And I remember reading about DeepMind's AlphaFold product, where they successfully predicted the protein folding structures for like all 200 million possible proteins. And I was like, oh my God, that is going to massively accelerate science. And like I've got this kind of weird, a little over my skis belief that if we all just hold on for another 5 or 10 years, most of the diseases that we're worried about are going to be somewhere between solved and on their way to solved. And so as little as I care for AI in the world of like human capital and human efficiency, like I'm really excited for it in science.
So I'm going to be really careful here because we could just like veer off this podcast into like a whole other conversation. So I'm going to just ask one follow up in terms of, I agree with the sentiment. I like where you're going. In the first question, you're basically like, I see 5-10 ideas a day, which just means you're incredibly intellectually curious. And then you're crutching yourself by writing your own emails, which says that, you just want to keep your brain going.
Yeah.
And I think there's a sense of that in LLMs, right? It's like, how to use it. Is this something that will do everything and we'll just be these, take whatever movie you want where we're just these limp bodies that don't do anything, but the counter for that is you could go to Chat, Claude, whatever your favorite one is, and you could actually have a conversation and maybe make something better. Meaning like you have that email and say, what am I missing? What am I, do you poo on that or?
No, I just find those to be the more marginal use cases. I think you're right, and any email I've got to write that is the kind of thing that I've never written before, I'd love a first draft from somebody that might know better, so that I can then turn my brain onto the first draft and ask like what I agree or disagree with, as opposed to just fighting through and writing the thing from scratch. But I think those things are. I think the time savings is useful. I think the little bit of starter thinking is useful, but also a very dangerous drug.
Fair enough. Yes. Yeah,
And
used it correctly. Yeah.
I'm just my dystopian movie is The Matrix that we're gonna plug into, and I want to fight as hard as I can against that. Like it's fun to be alive and to think for yourself. So
Got you. Okay, so you're in the underground in the Matrix. I got you. Okay, good. So I will use that example. It's great. You pulled up this trend, and I think that's how it goes. If you look at human history, innovation, most of the time it's not an individual saying, I have this incredible idea and coming out of the blue with it. There's lots and lots and lots of people thinking about it at the same time. It excites the human brain, those intellectually curious human brains. Some subset of the people it excites to do something about it. And what ends up happening is you get really excited, and the ones who are successful go and say, listen, I'm going to build this imaginative thing that they want to bring to life. And in order to do that, I need money. And they go to people and they say, give me money. Can you walk me through venture cap and private markets? Meaning once someone says, I want money, and maybe it's a second round, whatever, but I just want to get that sense. And if you don't mind, like one of the reasons I brought up the idea that lots of people do it, it's a trend, is just talking a little bit about the nuance of vintages when you get to it, if you get to it.
Yeah, sure.
Okay.
So everything I'm about to describe that is my best understanding of the state of the world today has actually changed a lot in the last, call it 15 years since I've been in the entrepreneurial world myself. But with that disclaimer aside, there's a bunch of different stages at which you can ask for money, and I'm just going to kind of take the categories and map them to where I think a company or an idea needs to be in order to be in that stage. So there's this concept of pre-seed investing, which is effectively just I wrote my idea down on a napkin, and if you think it's a good idea, and if you think I'm smart and that this could be something, and assuming that I need money to get it off the ground in the first place, which is not as strong an assumption as it might have been like 15 years ago. That's pre-seed. Seed stage investing is when you've got a little bit of traction. Like you've got the beginnings of a product that people might be ready to buy or have started to buy in the smallest increments, and you want to kind of make sure it doesn't die on the vine before it gets to a place where it could be a real business. Series A mostly now means that you've found real commercial traction and it's time to give this thing a chance to start scaling. Series B, and this is where I'm going to start being squishy. Series B is like we've given it a chance to start scaling, and it looks like the machine is holding up. Like you pumped some capital into it, you cranked it, and you continued to get customers at roughly the margins you were getting them before, maybe better, and the market is as big as you thought it was now that you've actually gone past the first handful of customers that you've gotten. Then there's a whole bunch of other letters that just represent like more capital at different points, but the way that I think about it after that is the rest of the rounds that you're raising are finishing proving that the machine is real and then potentially accelerating your growth with a proven machine faster than it would otherwise grow on its own for purposes like digging a moat around your company before anybody else competes with you, which is really a transition from what they call venture capital, which is like real risky stuff, to growth equity, which is quite a bit less risky and more about capturing an opportunity that's right in front of you while it's there.
Excellent. And I'll just bring up the vintage piece because the relevance of the vintage piece is, and we've been writing a lot about this in market commentaries of ours at Obsidian, is that the last 2 years, easy, and you could probably go multiple years before that, but let's just use 24 and 25. Most of the capital raised is going to something having to do with AI. And so if you invest in vintage year 24, vintage year 25, you go in and you say, I want to make an investment in private equity and I'm going to pick XYZ funds to make that investment. If it's a closed-end fund, they have 2 to 3 years to invest that money. If it was 24, 25, that's your vintage. And then you have a harvest period, and in a decade, you'll get your money back, and it could be an incredible amount of money. But it takes a long time, but that's what you're invested in. And so the vintages potentially represent concentration in what can be very exciting ideas that may or may not work out. Is that fair?
And also general sentiment, like
yeah.
I guess the flip side of the concentration comment is the sentiment comment. So everybody, quote unquote, everybody is now investing in AI companies, and that has to mean that capital is going into companies that are at the margins more likely to fail than they otherwise would have been, because there's a lot of capital chasing all of this AI stuff. So number one, you'd expect slightly higher failure rates within the company set that everybody is most excited about, if that's where just all the capital is going. And then the flip side of that, which has ramifications for other vintages, is that capital might have previously gone to support a nicely growing startup that's moving its way from Series A to Series B, and growing at 40% year over year, which historically is an amazing number for an early stage company. And now nobody cares about it, and as a result, they may those types of companies may be starved of the capital they need to get to their next thing, or to get to the state of maturity where they're fully viable. So it might have been the 2023 vintage that invested in the old companies, and now the 2024 and 2025 vintage sentiment is also having these other ramifications on the prior vintages. So like there's a whole set of potential effects. But you're definitely capturing the vintage in which your capital is being invested, is definitely capturing the majority sentiment of the day, and right now it's AI.
Yep. All right. So your story at Vested is pretty common among successful startups in that you had to pivot. It wasn't the original intention. If I have the story right, you could correct me. Can you tell us tell the audience the original vision of the company and how you ultimately pivoted to where you are today?
Yeah. The original vision of Vested was to be an equity education platform for startup employees. Basic premise being that economically speaking, most of the reason that people work at startups is for the startup equity, their paper lottery ticket that might one day, mean that they don't have to work again. But despite that being an economic reality, people just really don't do a good job understanding their equity, and they do a really terrible job making decisions around it at the few decision points that are important. So the original vision of Vested was, let's just educate the mass of startup employees, give them some free content and some free tools to help make their decisions a little bit better, and then one day we'll have a few million startup employees that are running around our website, talking to each other, talking to us, and then we'll figure out what to sell them. That was the original concept for Vested. And then what ended up happening was early in 2020-ish, basically the last time the venture market was starting to heat up and everybody was starting to take things a little bit more seriously, a lot of our existing users that were running around our website for the free content and the free tools started coming back inbound to us asking very squishy questions at the nexus of capital and their equity. And when we ended up talking to them about what it was they really wanted, and we had to talk to hundreds of them to really get the story fully fleshed out because the basic questions that they were asking were not articulated all that well. We thought that we would see lots of different, what I'll call life liquidity use cases. Like I want to turn my equity into cash so that I could buy groceries with it, so that I could put a down payment on a home, so that I could buy a car, so that I could pay unexpected medical bills. It turned out that what we saw instead was this one really consistent and really specific startup problem, which was I just left my startup job for whatever reason, like maybe Microsoft poached me, maybe I'm going back to business school, maybe I'm going to another startup for a higher title, maybe I got fired. It doesn't actually matter. And because I never read my docs in the first place, meaning the docs that I signed when I when I joined the startup around my equity, I only just found out that I have 90 days within which I have to exercise the stock options that I was granted, meaning I have to come up with the money to exercise them, or else I lose them entirely, which is a particularly rough thing to hear as a startup employee, because going back to my original comment, economically speaking, the stock options that you get when you join a startup are the reason to join a startup. It's not because they pay you market comp, they don't. So we saw this use case just coming up over and over and over and over again, and it wasn't coming inbound to us from our own user base because they thought we had money, because we didn't even conceive of ourselves as capital providers at that time. It was coming inbound to us because we were these people's Sherpa into the world of startup equity, which is how we had set ourselves up in the first place as like an equity education service. So they came to us asking this one specific question kind of over and over again in different forms. And past a certain point, we were like, man, something must be broken out in the world. Like this, like what? How is this not a solved problem already? This isn't a new problem that is 2020 specific. This is like a 20-year-old problem. So we did a bunch of market research on the market for the funding of an expiring stock option exercise. And what we found was basically that it was an incredibly robust market with respect to a tiny subset of people that had this problem. So the people that are, just pick on SpaceX because they just went public, the people that just left SpaceX and need $10 million to exercise their stock options, they got it. They had no problem getting the money they needed. Every bank would line up because, finding this person $10 million shortly before the rest of their net worth becomes liquid is a great way to generate a new wealth management client. So those folks were taken care of very well, but the people that needed $95,000 to exercise their stock options, in other words, like the rank and file startup employees, just had nowhere to go. And the primary reason that they had nowhere to go is because they're not, with total certainty, the next ultra high net worth client of a wealth management division of a bank or an independent RIA, and also putting $95,000 as an investor into an individual private company that might be in its earlier stages and isn't named SpaceX and isn't named Stripe or OpenAI or Anthropic is just not something that you want to spend time on. So we looked at the market. It made sense to us that this very, very large but very onesie-twosie market was relatively unserved, and we were just like, oh my God, that's like tens of billions of dollars a year that's going up in smoke in the small ticket part of the stock option exercise funding market. Like, if we can figure out some way to be the capital provider, that should be an attractive business, and we should be doing real good in the world.
Thanks for that. So I want to summarize some of what you said and ask a couple follow-up questions on that. So first of all, these employees come in, and you mentioned, and I don't want to be a little bit more fair to them, maybe, I don't know, but obviously a big component of it is, hey, we're going to get well compensated via equity, which means we have upside in these ideas. And then obviously they have to really buy into the idea. And some amount of people are either excited about their work environment or excited about the idea or excited about both. And that's going to compel them because they also have to work crazy hours.
Yeah.
So they're working crazy hours because they're excited. Hopefully, if you have a really good founder, he's exciting or she's exciting everyone in the base. They're excited, they're pumped. And then a few things go on. It's a young workforce. So if I have it right, some amount of people just move to some different portion of their life because they're young and that's life.
Yeah.
I imagine some portion decide they don't like the workforce. Some people don't believe in the idea. And then some people just get a better offer from a better idea with more upside. Are those fair? There's probably another bunch of quadrants, but is that kind of explaining why these people are out of the job, like leaving and they need your help?
Yeah, that's about right. And then there's one last set, which is just the folks that were part of a layoff. Like right now in the world of AI, like you see people trimming 10% of their staff just because they found a way to be more efficient, and maybe they're trying to signal to the rest of the investing. A founder is trying to signal to the rest of the investing world how focused they are on profitability. So sometimes people get laid off even at good companies in small amounts. So it's mostly just life happening to people.
Okay, and then you mentioned the example you used. So I just want to put a fine point before I go on. So what that means is because private companies are around for much longer, there's some disconnect in that. If I have it right, you'll correct me on this, but let's say the average life of an employee is 5 years, and the average life of a private company is like a decade. So therefore, there's tons of turnovers, and I think you used like tens of millions of dollars are going, into the garbage because they can't find financing. It's probably billions. Thank you. Tens of billions. I might have heard it wrong, but tens of billions of dollars are just getting destroyed. Right? It's value destruction, not for the company, by the way, but for individuals.
Yeah, for individuals. From the perspective of the folks who are granted those stock options, it is pure value destruction. It's pretty terrible. And that's right. They're just following natural life circumstances. On average, as of the last time we looked at this, startup employees were hanging around for about 3 years and change. And the tenure is a good, like, it takes us this long to potentially get liquid. Now it can be as long as 12 and 15 years when companies are really holding their breath for the biggest possible exit. So yeah, you get multiple layers of turnover within a normal startup employee base while the company is still completely illiquid and you can't turn your equity into cash. So
okay, yeah. and then so you use the example SpaceX, great example now, multi-million-dollar person. Is there? My gut is there's some combination of characteristics in terms of a minimum amount of money needed to get a bank or a capital provider interested across to what am I getting interested in? So SpaceX is really easy, right? But you still, even if SpaceX, and you're like, okay, I know it's going public, as you said, okay, someone has $50,000, there's docs, there's all these other elements that go into it. And then you kind of move down from SpaceX and maybe, and you could tell me, if you're a Series A or Series B, which is a much earlier, as mentioned, a series, but you have $8 million of value in the company, someone might get out of bed to actually write a check for $8 million. They'll have to do a lot of work, more work than maybe they have to do on SpaceX, but they'll get out of bed for it. So my gut is there's some amount of number, like capital, big round number that you need, and it erodes as you have less certainty on the company. Is that fair?
Yeah, that's totally fair.
Okay.
A
And
big enough number. a big enough number will get any capital source out of bed to do the work on a company and get to know it. But like, you're starting from scratch on a Series B company, whereas everybody knows SpaceX. So it's a significant amount of work. And also, if you're going to try to do an $8 million deal, just to pick that number, you're also going to want to diligence the person, and you're going to try to interact with the company. And just the amount of total friction on the transaction is quite high. So you need a bigger capital. It's got to be a bigger deal to justify the extra work.
Yeah, and by the way, that all makes so much sense. So how do you solve it? Are you just a crazy guy giving cash out? Like, no, I'm kidding. Like how do you solve the problem of how do I help a $75,000, someone with 100K of equity in a no-name for the masses, a no-name company?
Yeah, through a very, very different approach than is standard for bigger ticket investing, where you overpaper everything and get lawyers and due diligence up the wazoo and really, really get under the covers with an individual company and build bespoke models for that company. And, so what we do is we actually pick up a lot of private company data exhaust in the course of serving this very long tail of rank and file startup employees. And one of my backgrounds is on the heavily quantitative side in the financial services industry. And so we've got an internal selection model that is powered by, and by selection, I'm talking about company selection and figuring out which companies we like or don't like. It's powered by all the cool data that we pick up in the normal course of running this fairly scaled business. And we've already decided that even as outsiders, we like companies pretty well. We don't get all the way under the covers for any company. We're outsiders to all these companies, but we're comfortable with what we think of as the top 20% of VC-backed startups as outsiders. And then what we end up doing in order to support these individuals who might need that 95 grand a pop is we buy a subset of the shares that they're exercising their way into. That's like the machinery for getting them all the money they need to do their full exercise and own the remainder of their shares free and clear, which is the point of any transaction that we do. And we will typically buy it at the independently produced, board-approved fair market value of that company's common stock. Common stock being the underlying security that an employee with stock options has the right to buy, and therefore the security that we get our exposure to. And there will usually be a discount for lack of marketability that's baked into the way that fair market value is constructed. And if it's a real discount, like you can't sell the stuff you're buying, and so it's very easy to get caught holding the bag with a random security that you can't sell, and that kind of stinks. So it's a discount that exists for a reason. But if you are buying it with the intention of holding it, which is what we do in our funds, you can think about that as arbitrage. And so the two things that we combine to make this whole apparatus work so that we're not just random people giving out money is we do have a sense for who the best companies are based on all the data that we collect and the machine learning based selection model that we use to identify companies that we like. And we get a little bit of extra comfort from the implicit purchase discounts that are baked into the prices at which we tend to buy. So those two things help us bridge the comfort gap from the standard $10 million deal where you get full company financials and a board deck projecting financials for the next year.
Yeah, that's great. Sorry, what did you say?
I said, and then after having done all your work, you pay full price.
Got you. Okay. And I'm going to read, this is a testimonial off your website, just to put a fine point on this. If Vested didn't exist, I would have been screwed. I felt like I couldn't leave my previous company because I had all this equity I couldn't exercise, right? So, kudos to you to helping, right? At the end of the day, there's all this destroyed capital out there just based on, and I don't think it's anybody's reasons. I don't think anybody's trying to get anyone. It's just the way the capital stack works, and it's just, it's what you're going to give employees, and there's complexities around it, and these people are young, so they're going in, they should be educated, but it's hard. But the truth is, even if they were educated, they'd still go in. They just go in wide open, right? And maybe they try to solve for it a little earlier in the process of like this person of leaving. I bet you a lot of people leave and they're like, holy cow. When they get
Yeah,
noticed,
I
they're
was
like,
I was gonna
holy
say
cow.
the most common case is holy cow.
Yeah. I got
The the,
60
sec- the
days.
second
Where do
most
I
common
find this
case
money?
is I
Yeah.
know this problem is coming. I'm going to try to solve it ahead of time. I still have trouble solving it because there aren't too many vestas that are out there in the world. But the most common case is I never read my docs. Holy cow.
And so then you essentially, this is pooled capital, and the way you're doing it is by raising capital in funds and the like. And so you have
Yep.
pooled capital, and then so the other side of the equation is, let's talk about the risks. We spoke a little bit about the risks of startup, but do you have any stats that you could throw off the back of your head in terms of like how many companies don't make it in the venture cap world, in the A round, B round, et cetera?
It's interesting. So plenty of companies don't make it. But the headline numbers that get thrown around every so often about how many startups go to zero are relatively exaggerated, or at least they're cherry picked and not fully disclaimed. So there was a Harvard article some number of years ago that was like 90% of startups go to zero, and that's not right, not even close to right. When we did a roughly, let's call it low tens of thousands of companies historical analysis on a prior 10-year period that encompassed a bunch of market cycles. So it's not the current one and not the last few years, but we saw that from Series A and up, roughly 35% of companies actually went to zero, and then another like 10 or 15 points worth of companies had a fire sale exit, so they didn't go to zero. The investors got some money back. Probably the common stockholders, like the employees, didn't get any money, but that was roughly the blended number from a prior large sample 10-year period. And even if that number is ticked up significantly, it's never going to get anywhere near 90%. But the basic premise, which is that a lot of these companies do go to zero relative to like fully mature companies, is totally right. There's plenty of risk in the business that we run, and we kind of bake that risk into our operating model. Like we know that we're going to be helping a lot of people from companies that are going to zero, and we effectively need the rest of the portfolio to pull to make up that difference in the gap.
Yeah, that's fair. So you're providing capital to a multitude of people where you're aiming through your work to find the top 20%.
Yeah.
And so you're trying to mitigate the failures, and you're diversifying kind of across those vintages. So you're diversifying across mass ideas,
Yeah. And
different
we're
kinds of
diversifying within the top 20%, but believe it or not, that diversification is still necessary because plenty of the top 20% of companies go to zero. So, yeah.
Yeah, so kind of staying on the negative side of the equation with like how many companies fail. We started the conversation with what excited you, and that was accomplishment in terms of excitement. What scares you?
With respect to this specific business,
Entrepreneurship.
or just as an entrepreneur in general?
Yeah.
Okay, so yes to everything. Let's see. With respect to this specific business, the thing that scares me the most is that competition comes in a little bit earlier than expected. We do a very different thing. We do it in a very different way. I don't think we're going to get competition from the folks that pre-existed us doing stock option funding because they just have very different DNA than we do. But some well-heeled blue chip asset manager with $1 billion to spend on fast following our strategy, if they decide they like it earlier than we're ready for, then there could be competition. The embedded purchase discounts in these fair market valuations that get put together could erode over the course of time, and it could erode before we're ready and before we've ended up proving our model such that our investors have made enough money that they know that we're a trustworthy group of people to continue to provide capital for. So I can see that happening, which is why we're in a bit of a hurry to scale the operation and attempt to dig our moat as fast as we can. But that's mostly the risk that I see in the business. There's lots of little risks invested that we've just gotten entirely comfortable with over the course of time, so they're almost not even worth talking about. And then as an entrepreneur, just generally speaking, what freaks me out is it takes a long time to get to a place where you've created and captured value. Like before my second startup sold, like you can count 11 years. You can count 3 years of paying for law school and then 8 years of being in the startup wilderness one way or another. And real life doesn't love that level of lumpiness. Like, family and kids and
yeah.
So
That's fair. I think it's a very nice way to learn patience, isn't it?
yeah.
It's like let me be
that.
really patient here.
Well, I mean,
Yeah.
in the meantime, you kind of need to love. Like, it also forces you to be doing something that you love. Like, you can't spend that amount of time doing something that sucks,
That's
and
right.
and not getting paid.
Right, and that's by the way, going back to your beginning. That's why the accomplishment feels so good,
Yeah.
right? The labor of love, true labor of love. Um, so so, what has surprised you the most about entrepreneurship that nobody told you prior?
Maybe just how different it is constantly. Like you'd think that having done this 3 times, I'd have some sort of a playbook. And let's pretend that I do. It doesn't seem to apply to Vested. Like Vested's been its own thing from day one, and I've got a little bit of muscle memory on some important concepts like don't believe your own bullshit and things like that maybe I didn't have the very first time that I did this. But just every challenge seems idiosyncratic, and that feels like a generalizable comment. Like anytime you're doing something that is truly new, like of course your challenges are going to be truly new too. So that I should be used to it by now, but I'm not. So that's probably the that's the answer to your question for me.
Got you. And then on the investor side, do you think there's something that investors are misunderstanding about private markets, private equity markets in particular, or you think they have a good sense? Like what do you think is kind of like when you're going and you're speaking to folks where you think, well, I don't know that I agree with that sentiment.
Yeah, there's at least one thing that I've discerned in the last few years, which is that there is this theme, and I kind of think this is more of a marketing theme than anything else, that in the world of venture capital, the people that work in the venture capital firms that are making the decisions to back some companies and not others are uniquely good at picking winners.
Yeah.
And I think that can be true, but I think that much more often than not, that is a total smokescreen. Like it is deeply, deeply hard to pick winners in the earlier stages of a company's life. There's so many things that you haven't seen yet, and so many things that can happen to, like, from the founding team. And usually, when a company is doing really well and ready for funding, that's not the point at which they've faced adversity and you've seen them get through it. And there's so many things that can happen in the macro environment that can take entire verticals and sectors and make them less attractive. That I just think I think winner picking it's not a myth, but it's just wildly overdone in the narrative that venture firms pitch. So I think that is, unfortunately, I think they've done a good job with pitching that narrative, and it's made its way through to end investors that are like desperate to be in SpaceX and individual companies and be in the generational winners, and like it's just hard. I think.
Well, if you're pitching alpha, you gotta pitch that, and that's it. There's not much to it, so you have to have a compelling pitch. Not to take away, like, and there's low information, right? It's low information, so it does come down to, yeah.
Yeah, I think the thing that most falls apart in that narrative is variance. So you can be good at picking winners, and it is still possible to put 10 companies in a portfolio and go 0 for 10. And that doesn't actually mean you're bad at evaluating people and companies. It just means you only had 10 shots on goal, and over the course of many years, like, a bunch of randomness happened. Like that's the primary reason that at Vested we put together diversified portfolios. We just have this deeply embedded belief that picking winners is hard, but at the same time, you can't miss a winner in this asset class. Like, it's the Facebooks that return the full portfolio every so often, and like you therefore have to be diversified to make sure that all the winners are potentially in your catchment area.
Fair enough. So we're going to try something new here, and then we're going to give you a final question. All right? We're going to try a lightning round. We'll see how this goes. We'll ask some of our listeners what they thought. One word or short answers. You ready?
Yep.
Most underrated startup trait.
Resilience.
Most overrated startup trait.
It's not one word, but it's it's Steve Jobs' famous reality distortion field.
We'll cobble it all together, make it one word. What's the best piece of startup advice that you ignored?
Fail
That you
fast.
listened to? Say again?
Fail fast, which I don't think is fundamentally bad advice, but I think people hear the wrong thing when they hear it and they get ready to start something new, and then the first time they run into friction, they like run away. They're like, oh, this was a bad idea. And it's like, was it a bad idea, or was it just that the first instantiation of your first bit of execution was bad?
Yeah, that's right. It's grit and pivoting. Okay, 3 characteristics an investor should focus on when investing in early stage companies.
Well, let's see. Let me give you 4. 3 of them are fairly traditional, and 1 is just like a question that investors don't ask nearly as often as I think they should. So 1 is market size. Is this a market that's legitimately big enough to care about? 2 is whether you can protect yourself within that market, assuming that you make it and then capture your share of it, so the potential for a moat. 3 is this the set of people that are gonna build this market and put a moat around it? Like, why are you people special? And then the 4th one, which is the one that I think gets asked less often than it should, is as an investor, like, how can I help? Green money is relatively easy to find. Like, you should always look for your own value add in an opportunity.
Yeah, that's fair. That's great. Okay, so, Vesteds help to solve a liquidity gap within private markets. I think it's something Wall Street actually, by the way, does very well, meaning, looking to democratize, looking to, create all these better vehicles to get cash, to match capital with need. And I think it's one of the reasons that private markets have elongated. Companies go public less frequently because they have better access to capital and all these other elements and areas. What trend within private markets are you most excited about, and how do you think they're going to I guess it's kind of the same question, how private markets evolve over the next 5 to 10 years?
Yeah, there are a lot of trends right now in the private markets. I'm excited about some of them. I'm not in love with others, but I guess this is all just.
Yeah, okay, pick one. Give me one
right,
people should focus on, or 2 maybe if you got a tie.
One that I'm excited about, and this is just from our purchase at Vested, is companies are starting to pay a little bit more attention to how incredible it is for employees to get even the tiniest bit of liquidity support around their shares. And now I'm not talking about stock option exercise funding on their way out. I'm talking about like giving them a chance to sell 5% of their shares once a year, as income support. And so I'm starting to see some of the smarter companies treat company-sponsored liquidity programs as like a recruiting and a retention benefit.
Interesting.
Not to the point where it's where we're past the top of the pyramid. Like, this is not a broad-based thing yet, but it's, we're starting to see a little bit of inbound from forward-thinking CFOs asking us about this and like having a few test conversations, and that's a good thing. So I hope that trend continues and expands. On the other side of stuff, so on the access to regular investors with respect to the private market, I think there have been a couple, not necessarily foot faults, but there's some things that I've seen out in the world that I'm not in love with. I'm not in love with the interval and tender offer fund structures as it relates to venture type assets. So I think they're great for other things, but the fund structures that say if you want to get out every quarter, you probably can. those don't go well when things go down because everybody tries to get out, and there are typically gates put on to the redemptions. And as an investor, all you really hear the first time around is like, I can probably get out if I need, and then it turns out that you can't, and that's a terrible experience. I'm also not in love with the closed-end funds that go and trade on the New York Stock Exchange or the NASDAQ and that only have the SpaceXs, the OpenAIs, the Anthropics, the Stripes, etc. in them. Those to me feel like meme stock. I actually like the vehicle, and if it was a nicely diversified, well-constructed portfolio, I think it'd be a great way to both access the asset class and create liquidity so that you can get out when you need to. But the ones that have gone out thus far feel meme stocky to me, and I think that's relatively dangerous for your average investor who is not paying as much attention to the price at which they're buying in and what that needs to mean in terms of the underlying portfolio company performance in order to make any money at all. So those things feel dangerous. I guess there's like a middle trend, which is whether the secondary market for private shares is expanding, and we're part of that expansion a little bit, so that's kind of near and dear to the heart. I think it's probably not going to expand as much as people talk about over the next few years. I think the most fundamental problem is that you need to have a willing buyer for a given random company, and unless you know something about that company, who's supposed to buy? So I think there are 100 names that are now household names, like, private companies that are household names sufficient to have a buy side, and there's always a sell side in a market for private shares. So like those are the names that'll wash around, and that 100 might climb to 200 or it might climb to 300, but there's like 30,000 venture-backed startups in the US. I think we're going to find a local maximum in the next few years, or maybe even the next 5 to 10. I don't think we're going to find a global maximum.
Fair enough. Dave, thanks for coming on the show. Great conversation. Enjoyed it.
Yeah, happy to be here. Thank you for having me on.
That's it for this episode of Investment Wars. We're not here to chase narratives. We're here to challenge them, because better investing is not about having the loudest opinion. It's about having the clearest process. Subscribe on YouTube, Apple Podcasts, and Spotify so you don't miss an episode. And if you're a financial advisor, check out our companion show, Advisor Wars, where we tackle the business of advice, topics like alternatives, taxes, AI, and cash management. As Obsidian CIO sponsors the podcast to further educate and provide critical thinking about the factors that affect markets and investing. The podcast does not provide investment advice. Investment advice is offered only to clients of Obsidian CIO who have entered into an advisory agreement and with whom Obsidian CIO has identified individual objectives, risk tolerance, and other investment needs. Thank you.